I thought it sounded cool to have cash flow when I was younger. When we built Saint Archer, we made zero money, but we sold it for an astronomical amount. And when that happened, I went, it's all about equity and exit. It's not about cash flow.
All right, guys, welcome to another episode of The Report. Today, we got some sunshine outside, and we are almost at the halfway point of the year. And I'm very excited because we got a big meetup tonight. June Beers and Deals meetup here located in downtown San Diego. We got a special guest. I got my man back for round two. I got my man, Mikey Taylor. Mikey, welcome back to the show.
Yeah, it's good to see you. Thanks for having me.
Dude, it's been a minute. We were just talking how last time you were down here was May of last year. Like 13 months just freaking flies by, dude. It's crazy.
It flies by. We have 4 kids now, so it's really moving.
Yeah, man. 4? Well, congrats, bro. And your wife, Jen, is sitting right here. You brought her down this time.
Yep.
Loving the black leather jacket, Jen. And congrats on the 4th kid. What's the name?
Our newest baby is Vivian.
Vivian.
Yeah.
Okay.
Yeah.
Congrats. And how old's the oldest?
11.
11.
Scarlett.
Okay.
Yeah, I have 11, 9, 4, and 1.
Will there be a 5th?
That's interesting. As I look at my wife wants another one. So
Okay.
that probably means a yes.
Okay. She didn't even hesitate with a big smile, too. Okay. Will there be a 6th?
No, I don't know about that. Yeah, I think we call it at 5.
All right. So, you got a lot of stuff going on. You were co-founder of Saint Archer Brewing Company. You're the founder of Commune Capital. You're building all these crazy development deals. You got multiple funds. But dude, you just started a podcast.
I started a podcast.
Yeah, tell me about that.
I was doing a live is what happened. I was doing a live, like whatever, Instagram. And on there, I used to have a segment a long time ago called Mikey Days. It was before like really social media took off. And it was like a bi-weekly vlog in the skate world. And like kids liked it. And so I'm on this live and everyone's going, why don't you bring back Mikey Days? Why don't you bring back Mikey Days? And like my life looks different now. My life is not me, running into schools and skateboarding. It's, building apartments and being a husband and dad. I'm on city council. So I'm like, what am I going to do that, like, what would that look like? And so I was like, you know what? Why don't I just launch a podcast? We'll call it Life with Mikey. And I'll bring guests on, but it's going to be kind of focused on my world right now, which is, business, money, family, and culture, politics, culture. And so we launched it. We're 9 episodes in.
Okay.
Yeah.
Nice, man. Are you bringing on some of your skateboarding buddies too?
I am, but the skaters that come on are more of the business-focused one. Like I had Paul Rodriguez on, who was one of the co-founders of Saint Archer, runs a really big company called Primitive, and just so happens to be like one of the best skateboarders. And so I think that maybe lines up a little bit more, like just like the like raw core skateboarder. I don't really do podcasts.
Okay. You don't relate as much anymore. You want to be able to talk shop.
Yeah, and I just don't know if they'll get on a podcast.
Okay. Yeah.
Yeah,
I had Brandon Novak on recently. I know you guys you guys used to skate together. But he's doing a lot of cool stuff and inspiring a lot of folks with his sober life, which I thought was pretty cool and unique. And then Brandon Turner's coming on, not the real estate investor Brandon Turner, but skateboarder Brandon Turner. I didn't even know this dude lived in San Diego, but I remember watching him because I used to skate growing up, like when I was a little kid. I probably stopped when I was like 12, 13, but I remember watching a lot of skate videos, and Brandon Turner was like the young kid in the Shorties video that was like popular. I think Chad Muska was in that video. But he was like the young kid in the video. And so I'm like, oh, this kid lives in San Diego. Crazy. So
yeah,
he's going to come on too.
Yeah, bring him on. He's a cool guy. Super cool.
Yeah. But no, I feel you, man. I think there's a lot of, I think it's part of life as we grow. There's a lot of kids that I grew up with that like, as we grow, it's like, we might have a little bit less and less common with them, and we gravitate more towards what we're working on in the future. And, I never thought I'd be buying boutique hotels and having real estate funds. And I'm sure you never thought that 15 years ago either. But I enjoy talking shop with people that resonate with what I'm doing.
Yeah, 100%. I think that's like natural. I think as you get older, your circle just naturally gets a little bit smaller and your focus gets a little bit more niche down, and it's just life. I think that's normal.
Yeah, I realize that. It's like our circles get smaller as we grow, but also I realize like the person that you spend the most time with as you grow is like the person, your partner, person you're dating, right? So in your case, it's your spouse, it's Jen. If you're listening to this and you got a girlfriend or boyfriend, like that's the person that you probably spend the most time with. And I think that's why like selecting the right partner has a big impact on your future.
100%. 100%.
Yeah, I'm single right now, so one day I definitely want to have kids and get married and that sort of thing. But I'm holding out for the right person.
Good.
Yeah.
Yeah, that's good.
So another thing, man. What the fuck, dude? You're a freaking councilman now. Is it Thousand Oaks?
Thousand Oaks.
Dude,
Yeah.
how the hell did that come to fruition, man?
My wife and I grew up next door neighbors, right? So we've known each other since we were kids. And when we graduated, she couldn't wait to leave. She came down here, went to school at Point Loma. And that's when my skate career started taking off. So I started traveling all around the world, and I would leave my stuff in my hometown, Thousand Oaks. And it was like, for me, a good way to get out and see the world, but I was able to come back to like, my home where my friends and family were and kind of recharge. And so my wife and I had two different paths around 18, 19. Long story short, we start dating when she's home from Christmas one year. I think she was like 21 years old, 22. And then I convinced her to move back. And then we start having kids. And in our area, like, having kids is really cool there. It's small, it's quiet, it's safe, it's clean. It's kind of ideal for like a Southern California suburb. So we started having kids, but my wife was always kind of like, there's so much more. Like, why don't we live, like, we can live anywhere we want. Like, let's go live where there's more amenities or there's more things to do. And like, finally one day I opened my mouth and I was like, instead of us talking about like other places to live and what we're missing, why don't we just like be a part of creating that here? She like snaps back at me and she goes, yeah, what are you going to do about it then? So I tried to figure out how I can get involved without sacrificing my business, because we were 7 years in on our business. It is not at a point of fully running without me, and I care about it. So I didn't want to walk away from it. And so I was like, you know what? If I get involved with city council, you're talking business, real estate, growth of the city, and it's part-time, and I'm not the operator. I'm the policymaker. And so I was like, I'll run for city council. We had no idea what that meant. So we had to run a full campaign. I ran against 10 people.
Damn.
And our neighborhood's about 130,000 residents. So
Competitive.
it was super competitive. The fun thing about a campaign is it felt like a startup on steroids. Like, you had to build a team, which you're not paying. It's full, like, people donating time. You have to figure out your messaging. You have to figure out your marketing. You have to do your meet and greets. It was fun, but crazy.
What was the biggest key going into your campaign? Like, what was the one lever that you guys were going to pull the most?
Oh, as far as messaging or what we were going to do that was going to separate us from the
what
other people.
was your strategy going into this campaign that you guys were like, hey, if we do this one thing, we'll get shot to win?
All right, so my idea was this. First and foremost, you had to resonate with the community. So I felt like, what I saw our city being and what it ultimately could be, that had to resonate, and that I couldn't really control, right? This is how I see it, and if people are with me, then we've got something. But I just started with the messaging, and then my outlook was kind of simple. What is everyone else going to do, right? They're going to do meet and greets. They're going to take out ads in the local newspapers. They're going to do mailers. They're going to door knock. They're going to sit in front of Albertsons and Vons. I've got to do all of that better than them. And then I felt like I had to have one thing that they didn't have. And I thought that was digital marketing. And so we built out our team, and it was compete on every aspect. And then on the paid advertising part, we were going to create media the way you and I do, right? Like, we know what we're doing on that lane. And we were going to build out compelling, engaging content. And then we were going to pay and have a pretty specific ad campaign so that I was targeting the people that I wanted to see my content that would ultimately vote for me. No one had ever seen anything like that in our area. Like, no one even had a social media in the context of they weren't just going to start an Instagram and put a photo up of them and say, vote for me, right? Like an actual social strategy.
Yes.
And it worked.
Dude, that's crazy. How many paid ads did you guys shoot?
I think we did 10 to 12 videos.
Okay.
Maybe another 10 like copy or like graphic design stills. And then we just started running them. The hard part is our community is 130,000 people. Not everyone can vote. And so you started running out of people to hit. So it was, you hit the ceiling a little bit quick.
Yeah. Did you guys like test all 10 and then maybe the top 2 were performing the best and then threw all your dollars on those top 2? Or how did you guys do it?
Yes, but the problem was, I remember this happening. We went through the typical cycle that you would go through to get to like a well-performing ad.
Yeah.
And Eric, who ran my advertising, called me, goes, all right, we have 3. I'm like, great, let's 2x, 3x the ad spend. He goes, this is the problem. Just the little bit of dollars we put behind it, the same audience, which is your whole freaking city, has seen the same ad 3 times. So we almost lost the ability to do some of the more normal kind of strategies we would use.
Yeah.
And so what I ended up doing was created organic content, and the ones that would do good, then we'd put that into an ad campaign.
And you would test it with your like Instagram audience?
I created a separate Instagram.
Oh, really?
Mikey Taylor for city council.
Really?
Yeah.
Interesting. Okay.
Yeah, 5,000 followers, and they were all, it was more localized. So it made it a little bit easier to like truly test the waters.
And these were like legit fans that were like, all right, he's our guy.
No, not all of them.
Really?
No, yeah. When you
There's
run for,
some haters out there?
like I have never experienced before. Like
Yeah.
you start stepping into that sphere, even on the local level, people will follow every single thing you do, every link you give them, they're going to go to, like they monitor the crap out of you. And they are just waiting for you to either slip up or say something that they can splice and use against you. And so the pro of that, dude, my engagement was crazy. Like you have so many people looking at you, whether it's good or bad, the engagement is going to go nuts. But the challenge is that was a different type of hate. And I've been public facing for 20 years. I have never experienced anything like that.
Damn. What was
Yeah.
like the worst like hate thing you ever saw?
One of them, they built out a whole entire website that was,
Really?
yeah, I was like,
Dude.
I didn't think that I would have to like buy every single domain you could think of. You know, for example, Mikey for citycouncil.com, Mikey Taylor for citycouncil.com, Mikey Taylor for Thousand Oaks City Council. So I just bought the 2 I was going to use. Well, somebody grabbed one I didn't buy, and they built this whole website, and it was, you know, a photo of me, don't vote for Mikey Taylor, and then below it was like a picture of like a third world country, like, I don't know, somewhere in like the favela in Brazil, and it was, Mikey's going to turn Thousand Oaks into this. So it was like stuff like that, but
Damn.
where it started getting like raw is like all the, you know, like somebody said Mikey's a, you know, what did they say? A alt-right white Christian nationalist. All the racist stuff comes out, like all like it just labels for no reason started running rampant.
That's crazy. I mean, I can see like someone that's more liberal being like, oh, like he's going to make this very real estate investor friendly and all this sort of stuff. I could see that. But to say like, come out and say you're racist and all this other bullshit, that's a little crazy.
You know, the going into this, like I had an idea of where my weaknesses were going to be, or maybe the better way to say it is I had an idea of what my exposure was going to be and where people could go against me.
Yeah.
I thought they were going to come after me for being a skateboarder, right? Just the perception of skateboarders. I thought there was an opening there. And I thought real estate. Like I thought full-blown real estate was going to probably be the biggest one. They didn't touch it at all.
Interesting.
And so what ended up happening is they sold it so hard on one side, and I had such a established brand and presence on social already that they didn't match. And so what ended up happening is they started building my name recognition fast in my community for me. And then people started looking at me and going, wait a minute, something's not adding up. And then I got more people to vote for me than anyone else.
Yeah, they were hyping you up.
Yeah, it ended up working to my favor.
I always feel like whenever there's like haters out there, and surprisingly, I don't get a whole lot of it. I feel like the internet's a tough place. I see people on social media just getting torn apart, and I'm like, oh, I'm grateful because I've been lucky, fortunate enough. I don't get a lot of hate out there, and you seem like a really like nice, chill dude as well. I don't think you get a whole lot of it.
Oh,
Obviously,
I get my hate.
really a little
Oh,
bit, but
yeah.
it's not like a lot of people out there. I mean, you're not controversial. You're super friendly. You're respectful. Like you're a very likable dude. You're charismatic, and you're doing a lot of good for the community. And so like compared to some of these other folks out there that are have a very controversial take and opinion on everything, they receive a lot of hate stuff.
Look, I hear you on that.
Yeah.
And I try not to be controversial, and it's just not my nature, to tell you the truth.
But if you have an opinion, you say it,
If you
right?
have an opinion, it's controversial now. The things that should have never been controversial are.
Yeah.
And I think that's just kind of the cycle of time we're in.
Mm-hmm.
And if you say something matter of fact, bro, you're gonna get hit. You know, so I would say there's probably where I get the most hate, honestly, is from skaters.
Really?
Yeah.
Give me an
Yeah.
example.
Well, I would say the thing that skaters say a lot is, one, you're a sellout, you're a disgrace, You're
Damn.
putting dirt on your name. You were a
Damn.
legend, fallen, what do they say? Fallen from grace, like stuff like that. And, a lot of it is like, one, skaters still are pretty anti-corporation. They're still, somewhat counterculture. Money, success, like that's not really their lane. So I think they have a hard time with that is the first part. And then two, I don't think people are all the way comfortable with somebody who didn't go to school that talks about something like money. There's still a lot of people that hold this notion that in order for you to know something, you had to go to college and get a degree to do so. The numbers are still huge. At least it feels that way of people that think that. And so I get pushback there. You shouldn't be talking about this. You're not a certified financial planner or something like that.
Yeah. I saw a Twitter post earlier today. I forget who it was from, but it said, I thought it was interesting. It's exactly what you're talking about. It says C students run a lot of businesses. A students work for the C students.
Yeah.
And it said the dropouts run the whole world.
Yeah, that's right. I went to I was invited to go speak at this like administration schools, like a secondary school for kids that struggle in, the normal schools. And it was 8th or 9th graders. And they had me come there for city council, right? They're like, will you speak to the kids? I was like, yeah, for sure. And so one of the girls asked me, she's like, what would you recommend for a group like us who struggle in school? Like, we're clearly here because we had a hard time. And I said the same thing. I'm like, don't forget, the A students are the ones that work for the C students.
Mm.
And the ones that like didn't work in school, they end up creating businesses. So like, don't think that because you're here, your future is dark. Like a lot of times your future is actually brighter than anyone else's.
That's
You just
so
don't
good.
learn the same way.
Yeah.
I think it's true. I think it's totally true.
Why do you think that is?
Because school was built for one way of learning, right? It's a very structured, you do this and you do this and you do this and you don't ask questions. And the asking questions is probably the biggest tell that creates an opportunity for those that don't fit into this, narrow-minded path. Is building a business is all about testing, and it's all about kind of going against the grain, right? It's seeing what's happening in one industry and going, I could do something different. You can't have that outlook in school, right? Outlook, or, where you get in trouble in school is when you test the teacher, when you test ideas, and when you fail, you try things that don't work. That's not encouraged in school, and you have to have that to create a business. So I think the people that do good in school really like a strict and sharp box, and that's perfect for working for somebody. This is your role, and this is what you do, and this is the policy. Boom, 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 boom. And it's the entrepreneur that's wild.
I'm still surprised that they don't teach money, finance. They don't teach how like debt and like all this investing, like real estate investing, like none of that. They don't teach any of that in school, which is pretty shocking to me. Why do you think that is?
Okay, so there's a new bill. There's a bill, and then there's a initiative that's going to be on the 2024 ballot here.
Okay.
And it's called the California Personal Finance Act.
Mm.
And it is basically to put personal finance in schools. So schools will have to teach about money management, right? I think it's going to pass overwhelmingly. And now you want to talk about hate, right? I did a video talking about how this might come to fruition in California. I got blowback on that, because there's opposition for the idea that people shouldn't vote policies into curriculum, right? They have a plan and a process in which that happens. And it shouldn't be up to the citizen to choose that. That's the opposition, right? And I saw that on social as well. And the point I made that was an opinion was, look, you guys have had forever to put personal finance into the curriculum. And this is one of those things like reading and writing that every single person uses. Doesn't matter where you live, doesn't matter your degree, your sex, your race, you're using it.
Mm-hmm.
And you guys don't teach it at all? Like, you guys dropped the ball on this one. And the fact that people are finally going, hey, if you're not going to put it in the curriculum, we're going to force it. You can't push back on that. Like, that's your L, is my opinion. And so we'll see. The next question is, well, what are they going to teach? Right? Are they actually going to teach real money, or are they going to tell everybody that all debt is bad?
Right.
We'll see.
Yeah, it's interesting. I mean, to me, it's surprising that there would actually be people opposing the idea to teach finance in school in favor of some of these other things like that don't really matter a whole lot.
I was surprised too.
Learning some of these foreign languages that you might never use, art, learning about the 1400 history. Like, all this stuff,
I know. I know.
chemistry,
That's right.
my
That's
dude.
right.
But I don't know, man. It definitely is accurate what you said. It's like those who are curious and ask a lot of questions, that's a good sign that they're gonna make a good entrepreneur. A lot of what we do is asking questions. I don't know the answer to a lot of things that I do. I just know how to ask questions and get around people that might be able to help me.
Yeah, 100%. Like, think about, like, the entrepreneur mold. It's somebody who, like, is not normal. It's not the masses. It's typically a contrarian thinker, right? That is not, like, an ideal student for a teacher. Like, that is usually the pain in the butt that won't do what they're told. And so, I don't know, like, the school I don't even wanna go near the school system. Like, I love the idea of, like, trying to change it, but I think that's why so many people are moving towards homeschool. It's like there is clearly a gap that's happened in the school system that, 1, it works for most, not for all, and then 2, like, are our kids really thriving these days? Like,
Hmm.
I don't know. I think we've just lowered the bar so low on what the standard to excel is that we're seeing that pay out now.
Yeah. Do you homeschool your kids?
We do.
You do.
We
Okay.
do. My wife does.
Yeah, that's interesting because I volunteer with a 14-year-old boy. His name is Isaac. Shout out to Isaac. But I met him 5 years ago through the Big Brothers program, and I hang out with him once or twice a month. But I just went to his 8th grade graduation, and I'm hanging out with some of his classmates and some of his family, like his brothers and sisters or whatever, and they're all kind of in the same age range. But I don't know. I just like I see the kind of level of education that he's getting and receiving, and like what he's taken home with him, and I don't think it's anything special. It's very, very subpar, to be
Yeah,
honest with you.
I totally agree. I totally
I
agree.
don't I don't think he's learned a whole lot.
Yeah, and well, I mean, think about, like, I don't know how your experience was, but for me, what I really learned, like the stuff I'm actually using today, I didn't get from school. I
Mm.
got that after school. A lot of it I got from traveling.
Oh, totally. Me too.
Like being in other cultures, having to work with people, getting in arguments with my friends. I learned a lot from the skate community.
Hmm.
And like that's the stuff that I use more than anything today.
I think I've learned a lot from like sales, being in sales jobs when I was younger. Like I used to be a shy kid growing up, and my first job in sales was when I was 18 years old. I was a freshman in college, and I was working at North County Mall at a kiosk selling singular wireless cell phones. And this is before everyone had a cell phone. And I was forced to talk to strangers. And I was like, I remember the really awkward, uncomfortable thing for me, but I forced myself to do it over and over and over. And then I started to learn how to like effectively communicate with people. And those communication skills today, really help me with everything I do. Because let's face it, like everything that we do as entrepreneurs, and even if you're not an entrepreneur and you're listening to this, it's like, dating, talking to your kids, like going to a freaking vendor, go walking into a freaking like coffee shop and there's a big line or like whatever. Like it's all freaking communication and how you talk to people, and how you approach people, like is freaking huge. And if you're friendly, you treat people with respect, and you're a likable person, I mean, I'm sorry, I hate to say it, but like you are going to go further in life than if you were than someone else that is not friendly and likable and not respectable. And that's just the truth and matter of fact. And if you can effectively communicate, you're gonna win, and you're gonna win a lot more conversations than if you weren't.
Yeah, I agree. We're always selling all day long.
We are.
Yep, that's
Yeah.
right.
So I mean, I don't have kids, but like if you're trying to get your kid to like do some freaking chores before they go out and play, and they convince you they're gonna go out and play before they do it, then your kid just sold you, right? And so it's all sales, everything that we're doing. But I would say I learned a lot of my stuff from the sales, and then now today, it's like everything that I'm building. It's like the amount, and I'm sure you know this too. The amount that we're growing every single day, at least for me, is like it's like the hockey stick model, right? You get into something new and you grow, 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 and then you hit this like this point where it starts to go vertical. And just because like the growth and the technology and everything that we're doing, I think it just speeds up with time. So I don't know. I'm kind of feeling that, which brings me to my next question. I'm curious with you, man. I'm busy as an entrepreneur. I don't have kids. I'm not a freaking city councilman. And so what does your like normal day look like, with everything that you're juggling? You wake up and then what?
I wake up and go straight into the office. I try to get in the office usually between 7 or 8, and I'm there until 5. And then I get home, see the kids, make dinner, baths, get them in bed, go to sleep, wake up, do it again. That's without city council. So that's just my like in office Monday through Friday. City council is 2 meetings a month on Tuesdays, and they start typically around 5 o'clock, end anywhere from 9 to 11. And so, considering I have a city council meeting, I'll have an agenda that I have to go through. There's usually, I don't know, 3 to 900 pages, right? That's usually 2 hours on a Saturday or Sunday. I've got a call with the attorneys Monday, and then I go to city council that night. So that's basically the bulk of like my workload. And then Saturdays and Sundays, I don't work anymore. That was a big shift going from the old business to the current one. Is like Saturdays and Sundays are like my time to try to get caught up with the family. So we try to do something on Saturdays. We go to church on Sundays. We try to just like, be with friends or family throughout that afternoon and just like, get caught up as being a dad and a husband.
Yeah. The 8 or 9 to 5 that you're at the office, how do you typically split up the week there? Like how are you spending the majority of your time throughout the week?
Yeah, that's a good question. So right now I have it so Tuesdays and Thursdays are loaded towards like in-person meetings and more like admin and more like busy work.
Mm.
And then now Mondays, Wednesdays, and Fridays are geared more towards content or, events like today.
Mhm.
Right? I'm going to go see Rich. It's going to happen on a Wednesday, Friday, or Monday. It's starting to move more and more over to content though. Like, we made a big shift about a year and a half ago for me to be even more front facing and pull me out of, the day-to-day business, or at least a percentage of that. And since then, dude, we've seen like such a big shift positively in our business as far as leads coming in, which means more investors, which means more projects. So I would say I'm probably 35% now involved in the business, and the rest is going towards content, relationship build, stuff like that.
Yeah. What's your best method to bring in new investors to your business? You mentioned that that has ticked up since you started doing more content and that sort of thing. What's been the one driver to a lot of your new investor leads?
Okay, so this last year, like give everybody context, when I started the company, all of our money was raised the traditional way. It was people that I knew that invested in my last business. It was dinners and phone calls, right? Personal touches. 2019 is where I started making the shift of trying to get investors in digitally. And I think we got one. I think we raised like 25 grand in 2019 from social. Everything else was still conventional. 21, we started seeing a shift, and we started, oh gosh, how much did we raise 21? Maybe $5 million online. And when that happened, I was like, okay, we have something here. Now it's time to like really step on the gas. And I feel like last year was our year of really building out a foundation of our sales kind of side of the business to raise money through social media. And then this year, dude, it's turned into 85% of our capital stack.
Mm.
And so, this year, what will we raise this year? Maybe we'll raise 40 to 50 million bucks this year.
Damn, those are some big ass numbers.
It's crazy to think of. Like,
Yeah.
I don't take that lightly. It's crazy to think of. And so that's now becoming our biggest source. Now, it is a lot of work to raise money online, right? It's like you can create the leads. That's the part, at least for you and I, that feels a little bit easier, because one video, in theory, could generate 200 leads.
Yes.
But that does not mean 200 investors. So we have people now that are on call that hit somebody up the second their information comes in. There's almost 28 touch points that have to happen to then get somebody to a yes or no.
Mm.
And then when we get the yes or no, it's okay, onboarding, and then the process starts.
Wow.
That's the bulk of it. And then we're just now starting to focus on financial advisors or registered investment advisories, and bringing on advisors that have clients that are looking for alternatives, so that we can have one person that might bring in, 40 to 50 clients. That's a pretty decent check size. And so we are putting some energy towards that side of the business. And I would say those are probably the two now.
Yeah. Interesting, dude. 28 touch points. That's no
It's
joke,
a lot,
man.
dude. It's a lot.
And you guys are doing all this without a podcast. I mean, you just started your personal, but you guys have been doing all these big numbers without any sort of podcast.
All
Dude, that's
Instagram.
impressive, bro. Because
Yeah.
I gotta say, like, 95% of what we're raising is all from the podcast.
I don't doubt that at all.
Yeah, which is crazy.
Yeah, to tell you the truth, that is a big reason why we moved to more long form content. Is everything's short form now, and you get leads, but you don't get the trust built, right? So I wanted some verticals of content that people were spending an hour with us, because then they get to know you. So we do live calls now with our investors and our leads that happen twice a month. We never did that prior, and so we're moving towards that direction.
Yeah.
But I don't know. I like, especially in this day and age, the nuance of topics. Like you miss that on short form. So I am enjoying that on the podcast.
Yeah, and it's hard for people to get to know you like on a short form because it's like you can get 45 seconds to rip it, and you got to go, and it's got to be like good context. Otherwise, the watch time's going to fall off, And so I do like the podcast because you can rip a 2-hour podcast or even a quick one, 45 minutes, but it's still so much time. And I think like out of all the platforms out there, you got TikTok, Instagram, Facebook, Twitter, Threads, YouTube, and then you get the podcast platforms, which would be like Apple Podcasts, Spotify. I think out of all those different platforms, the podcast platform, the listeners, the audience is the highest net worth, the most sophisticated, the most intelligent, and they're action takers. And it kind of makes sense because, they're listening to you while they drive to work or they go work out at the gym, and they're listening because they're trying to better their lives. And those are the folks that we want as like investors and clients. And so we've found that the podcast listeners, like the trust is there. And so we jump on, it's like literally, it's not a big conversation. It's like, hey, been listening to the pod or whatever. And Tommy's our a guy that jumps in with all the capital raising calls, but it's a quick conversation usually. And some of our best like investors and clients have been freaking from the podcast, dude. And they're just freaking awesome people. Yeah. So I've found that, and it kind of makes sense, dude. Like when I got in the game, like it was just 5 years ago, and I started binge listening to the Bigger Pockets podcast. And I remember like I was listening because I was genuinely trying to learn myself, So it makes sense, but we haven't found a whole lot of like success on like TikTok, and I am on all those other platforms, but I haven't found a ton of success on those.
TikTok's different. It's a different beast.
Oh yeah.
We've gotten big investors. We've got like $1 million checks from TikTok.
From TikTok?
It's crazy.
Dude, how do you do that?
Yeah. And that was before the funnel. That was like in 2021.
Yeah.
I had some guy pop up on a Zoom. And I was like, what's going on?
Mm-hmm.
I'm like, how'd you find us?
Yeah.
And he goes, Mikey, I follow you on TikTok.
Damn.
I'm like, you do? And he goes, yeah. I'm like, well, tell me about yourself. And he was, from, I think, Arkansas, sold his business, had a ton of money, ended up investing with us once and then twice. And then I was like, dude, okay, it's on TikTok.
Damn.
Yeah, so but TikTok is definitely harder to pull people from onto like a Zoom call. Instagram is still the best for that, aside from maybe podcasting. But Instagram still is good for like people follow you, you've got the virality aspect, and you get hit them with a link, and they typically act.
Yeah.
No,
absolutely. Who's jumping on these investor calls?
A handful of people. Last time you saw my COO, Michael. So we try to have at least a principal who's talking to investors. We have Bruce, who will talk to investors. We have a girl, Hannah, that will talk to investors. And then every once in a while, I'll jump on as well.
Okay. That's cool, dude.
If you love real estate investing, passive income, and tax benefits, but don't have the time, my company, Summers Capital, is buying boutique hotels right now. We source the deals, we renovate the properties, and we even handle all the day-to-day management, making it truly hands-off for our investors. If you want to learn more to see if we can help you, visit summerscapital.com/invest to book a call with our team. Again, that's summerscapital.com/invest. Now back to the show.
So, man, I wanted to switch gears here a little bit, talk about the real estate side. So, I just had a couple folks on. I had Thatch Ginn on not too long ago. He's big on the ADU game. And I had Andrew Greer on recently. He's a name out here in San Diego. He's doing a lot of like smaller ADU builds. He'll like buy like a lot and then potentially build like 12 to 20 like ADUs and that sort of thing. But you're doing a little bit bigger development. You're building not ADUs, but straight multifamily units. How is that kind of game right now? And how's that landscape looking based on the political climate? And I know there's a lot of different laws that are shifting, such as being able to split up parcels in California now. That's coming down the pipeline potentially. So kind of give us an overview of what's going on in that space right now.
Okay, so multifamily development, if we're talking California, from a political standpoint, has never been better. I've never seen our state more open to development since I've been investing, since any of my partners have been investing. I mean, there's something unique happening with housing right now, where our state has, kind of created a housing crisis with how difficult it is to do business. And now everybody's frustrated. And now you're seeing politicians go, oh crap, what do we do? So it is easier to get projects through right now than it's ever been. The caveat, it is still harder to do real estate here than anywhere else. So even in a state that's making it as easy as possible, it is still 10 times harder than anywhere else. So that's kind of the political landscape. What we're seeing as far as what we're doing, we've seen cap rates move. Cap rates have softened almost a full percentage point, maybe 3/4 of a point. And if you don't know real estate, that is significant. I mean, that could be, a $60 million apartment now is worth 45. Like it's a big drop in value, which means if you're on the buying side, you have an opportunity to buy at a discount. There are a lot of distressed operators right now that we're building. They're now looking for their cash out refi, or not even a cash out refi. They're refi into permanent financing, and their projects aren't qualifying. And so you have a lot of rescue capital, a lot of private equity, or people coming in and gobbling up projects. So we're on we look at this outlook as this is the time to buy. I think this is probably the best time to buy in California since I started investing 20 years ago. That does not mean it's easy. It is very hard to do it right now because of the financing arm. So, your lending market, they're wanting 40-something% down, 40% loan to cost. So it's a big, big equity check in comparison to what it was 2 years ago. So hard to do right now, but I think it's go time on buying.
So give me an example of like the type of deals you're doing. So I know you're doing a project in North Park. Give me an example like what that looks like start to finish. So you guys bought this piece of land out in North Park. Was it an existing structure?
It was a duplex being rented out as an Airbnb.
On a big lot?
6,000 feet.
Okay.
Small lot.
That's the lot. 6,000 square feet. That is very small.
Yeah, we're building a 32-unit apartment.
And so you can just go high.
We went 8 stories.
8 stories. Okay.
Yeah.
Got it. And so so you buy this duplex and then you tear it down and you got to get the permits, right? How long does the permit take?
So on that project, it was very quick. We had basically permits
in hand.
They were RTI before closing. Like we were basically closed. We broke ground.
So someone bought it and got the permits
later.
And then was looking to exit.
Correct.
And you guys bought it from them.
Correct.
Okay, gotcha.
Yep. We actually we did a JV deal and brought them in, and they became the builder on it. And so they brought the project to us, and then we moved forward on it, and basically we got started right away. So it was quick. That one, just to use that example for the political landscape, in all of these cities throughout the state has forced cities to qualify their housing element, their arena numbers, on basically the added units that they have to add to a community. So basically, the state's going to say, San Diego, you've got to add 50,000 units over the next 8 years. And then San Diego's going to go, okay. And they're going to go through their general plan. They're going to start rezoning. They're going to start changing policy to fit this amount of units in certain areas. They're going to send that to the state, and then the state's either going to approve it or they're not. And for cities that are going out of compliance, right, what the state did is they created something called the builder's remedy. And the builder's remedy or the developer's remedy allows a builder to come in and basically develop around a city. It's like the easiest way to say it. And that has put cities in full-blown panic mode because that means the city has kind of lost control over keeping any new project in a position of fitting into the characteristics and style of the city, right? And so now all these cities are on, double time to figure out how to make this real estate work. So where we bought that project in North Park, they had a 4-story cap on new multifamily build, right? Well, they went, we're not going to be able to fit all these units in like this. We're going to change the policy. They stretched it out to 8-story. And so we were like the first ones to come in on it, which allowed us to take a duplex, build an 8-story, 32-unit apartment, and actually get some density to support the project. Stuff like that is happening everywhere.
I haven't heard of a ton of buyers that did what they did with you guys, because I know a lot of builders or people that are like investors that they'll buy a property like the duplex, get the plans, and typically the permits might take 12, 18, even 24 months. once it's shovel ready, then they'll look to maybe see, then get a number. But I haven't heard of any groups like being like, hey, let's bring in a partner and let's actually partner and still do the build out.
Yeah, so that one, like, if you look at our other deals we're doing right now, it's like the latter.
The latter.
We find something, we have to get it entitled, to go through the 2 to 3
Yeah.
years to do that.
And will you guys look to, as an exit strategy, be like, hey, let's just throw a number out there when we got the permits in hand and see if someone's willing to buy it?
Very rarely. Yeah,
Okay.
but we have done it before, like sell
Yeah.
the paper.
Yeah.
Um,
Oh, that's
but
what it's called?
yeah,
Sell
it's
the
like,
paper? I
yeah,
like
it's
that.
basically like you get something entitled and you've added value by doing so, so you sell it to a developer. Our outlook as a firm is, one, we want cash flow. And we are willing to build an apartment to a higher cap rate or a yield on cost that's higher than the current cap rate. And once we do that, we want to sit on these things. So we're less transactional and more wealth building minded. Like we want to own assets, and we want those assets to give us a good amount of depreciation so we can offset some of this taxable income. And then we want this thing spitting off cash for us. So it's like you sell the paper, that thing's one and done. You get a hit of money, and then what? You got to find somewhere else to put it.
Yeah, that makes sense. So you guys are doing the build out and then refinancing typically into long-term debt and holding long-term.
Yeah.
How much in assets do you guys currently hold right now?
Okay, so if you take out the assets that we have under construction, maybe it's 250 million.
Okay.
The assets we have under construction, what we do as a firm, we hold it at cost. And so we haven't calculated that into our AUM, but we have about 60 million under construction right now. And I think we have another 65 million slated over the next 10 months. So I don't know, you consider the value once it's stabilized, the 60 goes to what? 90 on both of
Yeah,
those.
so you're close to a half bill.
Yeah, so once these are finished, we'll get there, considering we don't do any more projects, but we'll do more projects.
Yeah. Well, what's the biggest risk with this model right now? Obviously, we know in our high rate environment, like when I go do these hotel renovations, the biggest risk is during the reno, because often we don't have any income coming in, and we got to be pretty dialed in terms of like our budgets, in terms of, hey, what's this going to cost to renovate, and also have enough reserve capital for or like contingency capital for change orders, or if we go over timeline. And then also we don't want to have too much money, because then it's going to water down the return profile for the investors. And so I think that period is probably the highest risk. And then of course, once we like open up, then there's a stabilization period. But for you guys, what is the biggest risk in your estimation?
I think it's similar risk.
Mhm.
When you're developing, it is so easy for the unknown to happen. And so, making sure the cost override doesn't run out on you, delay in project is significant. Like that does impact a deal. I would say probably at this point though, I feel like the biggest risk is the refi risk right now. Like you don't know what you don't know. And the Fed loves to tell us like a rosy picture that everything's going to be all right, but I don't know. And so you're making assumptions forward looking that interest rates and cap rates are going to be at a certain place. And if they're not, you're going to need capital. And so if you're not doing your deals right and you're over leveraged, I think that's a big risk right now. Now, I would say to hedge against that, you're putting 40% down. Like to not qualify with that much room in the deal, you got to kind of really blow it, So I would probably say construction going long and costing too much is probably something you need to be mindful of.
Mm-hmm. Yeah. And now when you guys buy like the land or on the front end, it's going to take 12, 18, 24 months to get the paper, you call it. Now for those first 2 years, you don't have a lot of investor capital in the deal, correct?
Yeah. How we typically structure it with investors, either we get it entitled or we're on the 1 yard line, then we bring investors in. So we try to not have investors involved in the entitlement risk. And then from that point, dude, you're still a year out to break ground. So in development, considering an investor comes in entitlement, we have our working drawing, everything that goes through to getting the permits. And then you've got your 18 to 22 months to build. So you do have downtime as far as cash coming in for an investor when it comes to development. But when done right, you get a big pop when that thing's done.
Yeah. And so you're refinancing, and then the refi money goes to paying off that initial loan. And then are you typically returning some money to the investors at that point?
Yeah, when considering if we had a refi that happened in the last 2 years, you're not doing a cash out refi, right? The cap
With the
rates have
rate,
moved.
yeah.
Prior to that, though, and then everything moving forward, usually it's not 100% of the capital return in the refi, but we target to get a pretty big chunk of capital back, 50, 60% of their principal investment back, and then they continue in on the deal.
Yeah. I mean, that makes up for not having the cash flow for a couple of years.
Yeah, and I think like just the return, like in development, your potential return is larger. Like, it needs to be because the risk is higher, right?
Yeah.
So like, I don't know, you're doing a value add play right now. Like, what's the net return to investor on a value add play? Like light to mid, 13% net.
In multifamily?
Yeah,
Yeah.
12, 13% net IRR. It's like development, you have a possibility of getting that thing closer to 20.
Well, a lot of this light value add multifamily, I know a lot of operators right now. I'm not going to say names, but I know some bigger name operators that aren't even doing distributions. They haven't been doing them for over 12 months.
Yeah,
So
honestly, I'll make the argument that
I mean,
right
if you want to
now,
call it what it is,
it is
I'm gonna put it out there.
it is what it is. Like,
Yeah.
to tell you the truth, there's really 2 ways to do real estate right now for talking multifamily. It's buying stabilized product in cash with no debt, or development. Other than that, I don't think anything else is working. Like, those are your 2 options right now.
And you say development, I agree with this because, in the rate environment, I think cash flow is just tough. I mean, let's just be honest. And I think, one, you got to be able to add tremendous value, and 2, be able to buy at a discount. And so you're doing 2 of those things with developing, especially you're building in expensive areas.
Right.
So North Park's one of them. Give me some other locations that you're building in.
Okay, so we're going to complete a project in Mar Vista, which is basically Santa Monica.
Okay.
Really, really low cap rate market. And then we have 3 projects in Ventura. Ventura, to me, is my favorite market in California.
Yeah, right on the
It
water.
might be my favorite market, period, right now.
Why?
Well, a couple reasons. One, in Southern California, there's not that many like coastal communities that aren't overdeveloped now. Like your Malibus, your Dana Points, your Newport, like everything's kind of been tapped. You have Oxnard and Ventura. That's kind of the last 2. And so I think there's a lot of growth opportunity there. The other component, the city council was so difficult in Ventura that they wouldn't allow anything to be done. And now, this was 2 years ago, they were the most undersupplied residential county in the entire nation. And then a month ago, they got targeted as the most expensive place to buy a home in the entire country. So they're so undersupplied that you can make the argument that you have the potential of a double pop, right? They're undersupplied, so if you can build it, you're going to fill it up, is the theory. And then 2, if institutional capital is going to come, which I believe it's going to, you're then going to ride a secondary wave, which is the whole place is about to blow from a capital infusion point. And so I'm very bullish on the market. We're about to put 200 units online. I would like to do significantly more than that.
Yeah. Dude, I don't understand why people go and develop in like these like Midwest markets.
I do.
'Cause I'm
What do
like,
you mean you don't? Yes,
Well,
you do.
well, I'll tell you why. Because I'm like, the cost, time, and risk to build, generally speaking, is going to be the same, this is generally speaking, in like an area like Oklahoma City or Cincinnati than it is in an area like Ventura, Santa Barbara, some of these high growth markets like La Jolla, San Diego. But we know that we're going to force a lot more appreciation in some of these high growth markets than we are out there. So I'm like, the same time and risk that's going to take to build out there, why would you not just do it in a very expensive market?
Okay, so I'm going to ask you, why don't people do it?
Because I think, well, that's a good question. So I think a couple of reasons. I think a lot of people that don't live in California don't invest here. I think they look at the political climate and they looked at the high cost and they're like, oh, like I don't understand it. I'm not going to go there. I think that's one. But I also think when I first got into real estate investing, I started buying stuff in these more like affordable markets because it was kind of easier for me to like grasp my mind around it, right? And there's less commas, there's less dollar signs, and you're like, oh, you get more units for the same amount of money. And so from that regard, and the cap rates are higher, so then the stabilized cash flow is theoretically going to be higher, right? Because what's a cap rate? If anyone listening to this is wondering, cap rate is a market's opinion or risk-adjusted return. And so, someone is willing to pay the same price for an asset. They're willing to pay a higher price for the same amount of cash flow, right? In an area like Ventura or an area like Santa Barbara, because they know there's going to be so much more appreciation on the back end. So to them, it's lower risk. Now, that said, I think with the higher cash flow in some of those markets, yes, okay, you're going to get more doors, you're going to get more cash flow, you get in for a little bit less money. But, in all reality, I think my progression has shifted as I've grown to where I'm like, dude, the cash flow is great, but like true wealth is built through appreciation, right? And once you really realize that, it's like, okay, that's why my progression now, I'm like, dude, we're buying in high growth markets where we like nice locations. All the hotels that we're doing are in great locations. They're near the water or on the water. And also, I think like you guys are taking advantage of all the political climate. We are taking advantage of the political climate as well. I think traditional real estate investing, people that get into long-term rentals or multifamily, I hear them say all the time, and these are people that don't live in California as well, primarily, but they say, hey, I like to go to like landlord-friendly areas, right? Places like Texas, places like Florida, places like Arizona, for those reasons. But for boutique hotels, dude, we think the opposite. We like to go into areas that have, bureaucracy, red tape, and those areas tend to have tighter short-term rental regulations, tightening Airbnb regulations, which is bringing more demand, more ADR, more revenue to the boutique hotels. And so that's why I feel like in those types of areas in California, the boutique hotels are undervalued right now, right? And so that's kind of our mentality, which is a little bit opposite than the traditional real estate investors. So, and you guys are taking advantage of the same kind of principles as well.
Well, yeah, I mean, just think like the reason why people invest in Texas and Florida and these
Yes.
easy markets is it's human behavior. Like we go where it's easy and comfortable. And that's where the masses go. We don't realize that by doing that, we're going in areas that have no opportunity because everyone else is there. So I think there's a very strong argument towards the contrarian view. It's just uncomfortable. Like it's uncomfortable when you're doing something over here and you're watching 20 of your boys over there going, you're blowing it. That's not the reality, right? So I think that's one part. The other part about cash flow, like you only worry about cash flow when you're old and wanting to retire. But if you look at how you make money, think of it, take real estate out of it. Think of it as business, right? How do you make money with business? You build something, you sell it. Ask any tech guy, right? They're not building a cash flow business that's going to bring in a couple $1,000,000 a year. They're looking for $100+ million exit, right? So for us, what happens is you talk to a 30 or 40-year-old investor and they're like, I want the cash flow. And you're like, why? Like, why aren't you trying to double your money every 5 years and do that over and over and over and then try to move it into a cash flow asset? Because your return threshold is going to be much lower. And so I'm with you on that. Like, I thought it sounded cool to have cash flow when I was younger. When we built Saint Archer, we made zero money, but we sold it for an astronomical amount. And when that happened, I went, it's all about equity and exit. It's not about cash flow.
Yeah. No, I totally agree with you. And I think, for someone that's looking to like replace their W-2 income and they're just like, okay, I need this to like be able to get out of my day job. And then this will allow me to kind of go take more risks and like pick my spots. I get that. So go get it. And I think that's what, some of those markets might be. But then at a certain point, once you're like, okay, my basic needs are covered, then it's like, okay, you need to change your perspective and you need to start investing for the appreciation, for those nice pops. And I think, the time that we're in, this environment that we're in, and you alluded to this at the top of the show, is like, yeah, we're in a higher rate environment. And so, those days of like being on a refi every couple of years has kind of slowed down a little bit. But, this environment is temporary. It's not forever. So I think if you can, buy good deals right now, good locations at a discount, the discounts are out there. I'm seeing them on the hotel side. And obviously, if you are diligent and you really want it bad enough, you will find the deals. You guys are buying deals right now.
Yep.
I think, the Federal Reserve printed 80% of the money supply since 2020. A lot of the chips are off the table right now because of the high rate environment, and a lot of that money's or is on the sidelines. But when these rates normalize at some point, a lot of the money is going to be reinjected in the economy, and we are going to see rent growth continue. We are going to see asset appreciation continue. And, people think rents are high right now. They think real estate is unaffordable right now. I'm like, yo, just give it 10 years.
Yep, that's right. And look, the other thing that like is important to note, cash flow is the lifeblood of an asset. Cash flow is important, but I don't think it should be your sole focus. Like you do need cash flow to support your debt service, right? But on top of that, like let's wealth build. But it's funny, as you and I started talking about equity and selling, My wife started looking at us, right? Like,
Yeah.
you do
Jen's
need,
all perked up right
because
now.
this is the thing.
Let's go,
Look,
Jen.
this is the thing about equity, though. When you're building equity, you're not realizing it. It's silent, right? It's the money that you're realizing is the money you get to feel and spend. And so, like, there's a balance with that for sure, but I would hesitate towards putting your entire focus on cash flow when you're young. Worry about that in your 60s.
You can build long-term wealth at any point. You don't need to do it when you're young. I mean, there's also an opportunity cost, of parking your money into some of these cash flow assets, but versus some of these every deal that I bought to this point, with the exception of maybe one, has been a deal to where I can add value.
Well, yeah, and then think about the adding value. Like, do you get to depreciate that when you add
If
capital?
you
100%.
depreciate your entire cost basis.
So it's like now you're talking about like tax incentives when you're buying real estate, as opposed to just buying something stabilized and getting like a just traditional straight line. Like, develop that thing, put money into it. Like that ends up being helpful when it comes to your tax incentive.
Yeah, and even if you're like listening to this show right now and you're like, dude, I don't raise money from investors, I don't have a fund and all this, it's like, if you're not in raising money for investors, like, it makes even more sense to buy value add stuff, because now you can refinance your money out every couple of years when you add so much value, and then you can use that same set of money to continue to build your portfolio and buy more and more real estate. And so I think it makes a lot of sense for both aspects. But if you're just using like one set of money to build your portfolio, like, you have to buy assets that you can add value. But also, I think it takes a lot of risk off the table. In a high rate environment, I always say, like, one, I don't want to buy turnkey product because I think the market's going to continue to soften before it improves. I'm speculating, but I'm pretty sure that's going to be the case. And I'm pretty sure that rates are probably going to be high for a little bit now. And knowing that, it's like, well, I can't buy turnkey. I got to buy something to where I can get a discount. I can add tremendous value. That's going to give me a cushion and a buffer margin for error should the market continue to soften, which I think it's going to.
Yeah. I mean, yes. I always want to add value.
Yeah.
Just like for people that don't know the real estate game, you typically aren't going to get permanent financing when you're doing a big value add play. So you're in like the bridge debt space. There is risk with debt always. So, do I agree with your outlook? I do. I think interest rates are staying higher than people realize for longer. When they drop, I think you're going to see a huge amount of capital come in. I actually think you're going to see a huge amount of capital come in prior to it. The safest way to buy real estate, honestly, is to buy stabilized assets with no debt. That's the safest. Your return is going to be basically the cap rate, though, right? So just be mindful of that. Like, where is the sweet spot where the return matches the risk profile? That's really where you're trying to land.
Okay. Well, if that's the safe way to buy real estate, and I agree with you, if you want to go like Dave Ramsey, that is the safe way. Are there commercial like real estate investors that buy like the bigger assets that you guys are buying that just pay cash? Because I know it's kind of a Southern California thing.
Yeah, they
right?
are.
These guys with deep pockets are just like,
Dude,
fuck
Grant's doing it right now.
Really?
Yeah, Grant's buying huge product.
Just
no
straight
debt.
cash.
Straight cash. Because think about it, you have to. If you're going to buy a Class A product at a 4.5 cap or even a 5 cap, what's your interest rate right now? It's north of that. So the asset doesn't even cover the debt service. So you have to take debt off the table. And now you have, you're not allowed to say this, but you have like the bond alternative. No, you can't say that about real estate, but seriously, like the return on a stabilized product, no debt, is comparable to a bond-like return.
Mm-hmm.
It's very boring. The only thing that really gets exciting about real estate is it's truly leverage. It's debt that makes it exciting. Without it, you're talking 6%.
Yeah, I mean, if you're putting down, let's just say on average, well, probably not in California, but let's just say, because I was out in Turkey, this is a couple of years ago, and I was in a place called Kaş, Turkey. I was like kind of traveling up the Turkish Riviera. And there's this badass beach town in Kaş that like literally was like, had all these beautiful cliffs overlooking the water. I was like, fuck, like I was staying in a really badass Airbnb that was brand new. It was like an 8-plex. There was a bunch of like really, really nice 2-bedroom, 2-bath units. And I was like, how much should one of these cost? And so I was actually talking to the host, and he was like, oh yeah, you can pick one of these up for like $200,000 US. And I was like, damn, that's not bad. And so I was talking to a realtor down there in the area, and he was like, dude, the rate environment's like 22%. So he's like, you have to pay cash. And so I'm just thinking about that from a real estate investing standpoint. It's like, That same investment in Turkey where you had to pay cash, where here for like a short-term rental, on average, maybe you put 20% down, you're getting a 5x multiple on your money. That investment out in Turkey where I pay cash would have to do 5 times as good as the investment here just to break even. And that's not including all the freaking tax benefits that we get here in the US. And so a lot of people ask me, hey, have you ever thought about doing a boutique hotel overseas? And I'm like, no, that's the main reason. But the second reason is like, our investors invested this because we understand this market, but also the tax benefits. Like real estate's about debt and taxes, right? The appreciation is the big bang. Debt and taxes are great. Yeah, you get a little steady flow of cash flow, and that's great too. But debt and taxes is the play. And so we go overseas, we don't have the debt and the taxes, and we don't have that multiple because we got to pay cash. And it's a market that we don't understand. We don't have a competitive advantage in it. So I'm like, why the fuck would I take investor money and go out there? It doesn't make any sense.
Yeah, we don't do that either.
I want to sleep good at night.
100%. 100%.
Yeah. Now, if it's like one day I got if I get a ton of money one day and I'm just like, okay, I'm going to go park some of my own cash. Okay, maybe I would do something like that, but I'm not going to take investor money and go do that. No way in hell.
No.
Yeah. So with all these deals that you guys are doing, are you guys actively buying right now?
Oh yeah.
What's your search criteria?
Yeah, we actually just closed on a property 2 weeks ago exactly.
Congrats.
Thank you.
What did you guys buy?
We bought actually a piece of land that we're going to develop about a 62 unit apartment on in Ventura. Our buy criteria, I would say there's going to be some like over generalizing here. I want a difficult market. Like I want there to be a high barrier to entry. I want there to be a lot of demand for it, which is basically we're specific to Southern California right now.
Mm-hmm.
I'll tell you what I really like. I like the cities that are starting to change policy that are making it friendlier for investors. And when you pair that with the just difficult nature of doing business in California, you have heavy regulation that keeps everyone out. But the ones that are here, I like cities like San Diego or like what's going on in Ventura where they're going, you know what? We're going to allow you guys to do a little bit more. So the city in which we're investing in is big. But really, I want it undersupplied and I want it to be somewhat difficult.
Yeah.
What we get it for, it depends. Like the cost of the land is going to be part of the equation. The rents that we're going to be able to get. I would say this, like to keep it simple. I need to see about a 25 to 28% project level IRR for a deal to work.
Annualized, yeah.
If the project level gets there, then myself and our investors are going to hit what we're trying to hit. When it starts getting lower than that, it's not worth it for us.
Yeah.
So I don't know. We got to build to, how much are we spending to build? $450 a door, probably. $450 a unit is what we're spending right now to build.
And what does that equate to on a square foot basis?
Oh gosh, what's the cost per square foot on that? I don't know offhand.
Yeah.
But really at the end of the day, it's about demand. Like, will people lease our apartment up and will the demand be here for the next 10 years? The answer is yes, then we feel good about moving on it.
Yeah, I mean, that makes sense. San Diego is actually like one of the highest average rents in like freaking America. But on the same token, and people always like poo-poo that, but at the same token, I'm very bullish on San Diego. It was actually ranked number 2 in the Marcus and Millichap multifamily like forecast for 2024. It was the number 2 ranked market. They rank all the top 50 markets. But I always say, I'm like, dude, if you take the 4 major markets in California, you got the Bay Area, LA, Orange County, and San Diego. San Diego, you could argue, has the best beaches, the best climate, the best vibe, the coolest people. There's the least amount of traffic. Like you can drive from one corner of the county to the other and like everything's 20 minutes from each other, right? And if you look at it, it's the most affordable out of those 4 markets. And, a lot of tech companies are migrating down here from the Bay. You have the Navy presence here. That's never going to stop. And so there's a lot of diversity in terms of the job market. But then also, San Diego's kind of an island. So to the north, you got Camp Pendleton. To the west, you got the Pacific Ocean. To the south, you got the Mexican border. And to the east, you got the mountain ranges. So from a supply standpoint, there's not a lot of land to build on. And I think for those reasons, I like San Diego. We do a lot of like, one of our companies here is we manage short-term rentals and boutique hotels. So we'll manage our own stuff. We'll also manage for third-party folks, on a select basis. But we manage in like 8 markets around the country, short-term rentals and the hotels. San Diego, hands down, is the best market. Like, we don't have to push and pull in these listings. There's no seasonality here. They just stay full year round. And so I'm bullish on this area. I think rents are going to continue to go up. I live in a brand new construction, 440 unit building here in this neighborhood downtown. And they just built this building in July of last year. Typically, those types of buildings are going to take, about 18 months to lease up. They did the entire lease up in less than 12 months, no concessions.
Yeah, so
That's fucking crazy, right?
The last time I looked, San Diego was short like 108,000 residential units. This was
Damn.
like a year ago.
Yeah.
That was the number, right? They haven't built close to that since. And then, to add to your point you're making, on one of our projects in Ventura, there was a building that went up behind us. It went up 12 months ago, right? It's about 50 units, so not a big one. They were fully occupied 3 months, no concessions. So basically, here's the case for California investing. The housing crisis is so severe that for you to rent a unit at an apartment, you basically need to know the developer to lock it down before it's finished, or you have no chance finding something. It's that bad. And so
Say that one more time.
So basically, the housing shortage is so severe, we are so undersupplied that you basically have to know the developer or operator and lock down a unit before the apartment's complete to have something to rent, or you basically run out of options,
Yeah.
right? And so that is probably the strongest case to be made, that if you build it, it's not even a question of if they will come. They're here asking for it. Please give me. So it's like, you know how to do it. You're going to occupy. And if people aren't able to do it around you, rents are going to continue to climb.
I mean, I know people that are paying, $2,500 a month to like rent a room in a house.
Yeah, oh, yeah.
With like multiple roommates in San Diego. Like, think about that. That's crazy, right? Paying $2,500 to rent a room with 3 or 4 other roommates. Like, that is fucking nuts.
Yeah, but think of the comparison. Like, you can't even get a studio by us for $2,500.
What's the studio run up there?
Dude, like $3, close to like $2,800.
Damn. That's
That's a
crazy.
lot.
That's crazy, dude.
Yeah.
Yeah, so I don't know. I see a lot of cranes going up right now in this neighborhood. Now, location, like micro location specific, because, yeah, we're in downtown San Diego, and I live in Little Italy. I've been in this neighborhood 7 years now. This is where our office, the podcast that we're talking in right now, is located in. But this is like a hot neighborhood, right? It's trendy, and that's where the building is I live in that went up. And there's like a couple other high rises going up right now, and I'm sure those builders are like, fuck, thank God that one got leased up right away. Now, in East Village, if you go to the other side of downtown, that's not the case. Those buildings are struggling, and a lot of turnover. Vacancy rates are high. People don't want to stay out there because there's a lot of homeless. A lot of those buildings went up when like the San Diego Chargers were thinking about moving their stadium down there, and there was a lot of talks of like a whole convention center rebuild, and like the Chargers were going to build their thing out, and a bunch of new development was going to go down there. Well, that never happened. They went up to LA. And so that area really never got developed, and there's more homeless down there. And so it's a real issue, and they have a lot of oversupply. So that particular area, not so hot. But this is why, to your point, it's like, dude, you gotta build in the right locations.
Yeah,
it's
you
so freaking key.
Yeah, and you're talking the big stuff. Like, think about how long ago they decided to move forward on the projects that you're seeing cranes on right now. This wasn't a decision made 12 months ago.
Yeah.
This happened before COVID.
Sure.
So it's like, yeah, a lot can happen since then when you're playing the big game. But, on the other end, they're playing a different game than you and I. They don't need 15, 20% IRR. They need like a 6% coupon. So it's just a different type of investor.
I'm surprised that like how fast these freaking high rises go up. Like,
Yeah, they're
I just
good at it.
watched one go up right. Actually, it's a fun fact. You were at our meetup last year. It was rooftop. That rooftop no longer has any view. It's completely covered by like a 36th floor freaking high rise next to it. We moved our meetups since then. So our meetups at the building I live in, they have a really cool 35th floor sky lounge that like overlooks the whole city and the water. It's really dope. But that said, I've watched this building go up right in front of my unit over the last like 12 months, just like freaking so quick. I feel like they're doing a new floor every week.
Yeah.
Yeah.
Yeah, the big boys.
Yeah, it's crazy to think about. So where do you see, kind of development? I'm curious to see your thoughts. Where do you see the Southern California housing market, multifamily market going over the next like 10 years from now? I know it's a big time horizon, but I'm just kind of curious. A lot of these deals you guys are doing are 10-year projected hold periods, right?
Yeah. Well, okay. So like to give everybody context, if you're looking at California, we were building like crazy before the financial crash, right? Like if you look at our numbers from
You're talking about 2008?
leading
Yeah.
up to 2008, like 2001, 2, 3, 4, 5, 6, we were posting big numbers. The crash happened, and basically from 2008, we didn't really start posting numbers again. Like we had one good year in 17, and then like our numbers in like 21 were good, and then they fell off a cliff. And so building really has come to a halt if you're looking at the total state this last year, and it's still at a halt right now. And so the question becomes, when will building pick back up? And that's probably gonna give us a more real outlook on what the next 10 years looks like. If I were to guess, honestly, I think we're in this scenario for the next decade. I don't think we're gonna build our way out of this in the next 10 years. I think it's gonna take longer than that.
Dude, I've read multiple articles that say we're 5 to 6 million housing units short in America. But I've heard some other folks say this, that there's like 30 million dilapidated homes in America that are not rentable, not livable, they're not resellable, you can't get loans on them. And so you factor all those homes, we're really like 35 million housing units short.
Yeah, it's significant. The numbers being thrown around for our state are between 2 and 3.5 million, right? And our state averages 100,000 units per year of new residential build. That's what the historical new development has been over the last 10 years. So let me ask you, if we build 100,000 units a year and we're 3.5 million units short, when are we solving this problem?
35 plus 24, what does that number come out
It's
to?
2089.
Yeah, 89.
We won't hit 3.5 million units till 2089.
Damn, that's insane.
You know what I'm saying? So then you ask yourself, okay, well, what if we actually like do a good job and increase supply by 50%? You're still not hitting those numbers till like 2050. So what's it going to take for us to build our way out of this? You're going to have to see our state do a complete 180 on our outlook of business and development. They're going to have to go cut the red tape, get the regulation out of here, and let these people build.
But you don't want that.
You would have to see our state do a 100% flip. You know what I'm saying? You'd have to watch our state, at least from an economic standpoint, go from bright blue to bright red. You know, our state is not a let's make it easy for people to do business. Our state is let's regulate.
Yeah.
You know, so I just don't think I don't see a big shift in our political leadership changing that significantly.
And that's just on the supply side. But if you look at the demand side, I mean, with shifting demographics in household formations, I mean, if you look at the baby boomers are living longer, they're not moving out of their homes and going to retirement homes as early as they once were. And then you got the millennials, my generation, a lot of my friends and peers, like they are literally starting families or buying their first homes. And then the Gen Zs behind us, I believe they're even bigger. They're moving out of their parents' house for the first time. They're looking to rent apartments. And so if you look at the shifting demographics and the demand side, that's ticking up, right? And I think it's a telltale sign when you see the rate environment. And I'm sure if, I would have told you 3 years ago, hey, the rates are going to more than double for a 2-year span, but housing prices are going to be relatively untouched, you would have fucking thought I was crazy.
I would have full blown thought you were crazy.
Yeah, right.
Yeah.
And so you think about it, the rate environment started ticking up in Q1 of 2022. We are now approaching Q3 of 2024. So it's been now 10 quarters. That's 2.5 fucking years. And the rates have more than doubled. I mean, we were in a 2.75 rate environment for a fucking single family home. Think about a VA loan back then, you get 2.75, no money down. Like, think about that. That's fucking free money.
That's actually so interesting that you say that.
Yeah. And so think about that. We're 10 quarters, 2.5 years. We were in a 2.75 rate environment. And now that same loan product is, mid sixes. So that's 2.5x on the rate, 10 quarters straight, 2.5 years. And housing prices have maybe took a 10% bath. Think about that. That doesn't make sense, but that's a testament to how strong the supply and demand fundamentals really are and how short we really are in terms of supply to meet the shifting demographics and the demand that's ultimately evolving, and that's not going to slow down.
Yeah, and you know what's interesting? As you're saying this, I didn't even consider it. We talk about the amount of units that we're short in the state being somewhere between 2 and 3.5 million units, right?
Mm-hmm.
That doesn't even consider the fact that the Fed just locked out millions of homes from being able to be sold for God knows how
Yes.
long, 30 years. They
Locked
just
up.
locked in those houses,
Yes.
30-year fixed at 2%. No one is selling those. Those will not be sold. That just brings the supply-demand ratio even more out of balance, right? But ask somebody about investing in California. 9 times out of 10, they're going to tell you you're a lunatic. They're not going to tell you to do it here.
Dude, whenever I post like any sort of content that's like alluding to like the landlord tenant laws in California, oh my God, people fucking love those. They love to chime in. Oh my God, I'd never fucking live there. I'd never invest there. But in all reality, dude, I've invested in like all these freaking markets around the country, but like the ones that I've like, made the most wealth from are the ones here in California, dude.
I know. We just did this. Jen came out. She got to see this. We went out to Idaho 3 months ago when we were raising money for our last fund. And we have a advisor who's a partner, brings, clients into deals, and he arranged a dinner for about 18 people for us to talk about our investment with, right? And before the dinner starts, he comes up to me, my partner comes up to me, Michael, and goes, dude, 3/4 of these people moved from California. They are not stoked on California real estate, right? I'm like, okay, this is going to be interesting. And so we started the entire pitch basically exactly like that. Look, we understand how bad the politics are here. We understand the cost. We understand how painful it is to do life here. But that also created the greatest opportunity. They're like, what are you talking about, right? And then like by the end of it, you had not the whole room, but you had a large amount of the room that was like, oh my gosh, I want to invest in this. So we just forget that like a lot of the policies that are truthfully awful, and I'll tell you the majority of ours are, they also created an opportunity to make money. And so that's what we're up against. Bad policies create gaps, and that gap created an opportunity for investors to make money.
Yeah. I mean, I think that's a lot of different, sectors and business ventures. It's not just real estate, but, typically, generally speaking, the higher the barrier to entry, the higher the potential payout's going to be. And that's just the truth of the matter. Less competition too. Well, dude, I appreciate you coming on, man. Excited to go rip at the meetup. Where can the folks get in touch with you?
Best way is probably just on social media, Mikey Taylor on all the platforms. Our business is Commune Capital, so communecapital.com, or you can find us on social media and check us out. And then the podcast, I got to give a shout out.
Plug that podcast.
It's
and
Life.
I want to be a guest too.
We are lining that up. It's Life with Mikey. We're on Spotify, Apple, YouTube. Check us out. We would love to hang with you on the podcast.
Yeah, man. You were recording up at your spot in Ventura. Is that where it is?
Yeah.
Okay.
We'll have you. We'll schedule that and get you in. I just don't have a boat. I don't have a boutique hotel to put you in. I got to level up on that regard.
Yeah, you're staying at the hotels in Dale tonight, you and Jen. So you definitely have to give it. Oh, Jen's into the design space. So you were telling me that before we started recording. So excited to hear your feedback, Jen. But that said, he's Mikey Taylor. I'm Rich Summers. Listeners, thanks for tuning in. We'll see you in the next one. Peace.